Just given just how we've seen central banks here, even in Asia, that are starting to really catch up with the Fed, can we start to maybe get it right when it comes to pricing in the peak dollar kind of scenario?
Unfortunately, I think that's going to continue to be a moving target. I think markets have generally sort of come to the idea that, or the assumption that they can forecast the terminal rate for the Fed. I don't think the Fed even knows what the terminal rate is, and it's very possible 3 months from now we'll be talking about a higher terminal rate. So ultimately, seeing the dollar sort of slow down, I think, is still a little bit of in the dream category for now. But ultimately, for a weaker dollar to manifest itself, you need a strong euro, and fundamentally, it remains pretty much impaired for the next several months, given there's an impending energy crisis there and an imploding current account.
And inflation, which is rampant, Mazen, as well. So, that's the euro, and that's below parity now. But the biggest victim of dollar strength amongst the majors has got to be the yen. But is it the major victim because it's actually pricing in economic fundamentals for a country which has an economy which is many called moribund?
Yeah, look, when it comes to the yen, and specifically dollar yen, what's really been explaining a lot of the variation over the last 6 months or so, and it continues to be the case, has been the interest rate spread. And ultimately, that spread is almost primarily driven by the U.S. leg of it. So ultimately, in order to call a top in dollar yen, you need to call where the terminal rate is for the Fed. Until we get to that point, it's going to be very difficult to see dollar yen significantly or materially turn lower from here. But on a cross basis, you could see the yen act a little bit more as a growth hedge against the Aussies, against CADs, against even the euro as well. So I think ultimately against the dollar, I think you generally want to stay clear. And as you look at a lot of Asian currencies as well, where they've built up several or significant amount of FX reserves, they're really leaning into that at the moment to prevent what could have otherwise been a much steeper decline in their currencies.
So, Mazen, David here, that takes us straight to your earlier point then on the euro, because what happens to the dollar, I guess, is largely driven by, that big part of the basket. Do you think we've seen the lows of the cycle on euro? Because you've exited that short position or that short trade, but then you also seeing a little bit more downside to about 80 cents. So just take us through the thinking there.
Yeah, so on a tactical basis, taking profit around parity was sort of the initial target. And I think there's been a lot of downside or concerns being priced in to markets ahead of Jackson Hole and what Powell could say. Our stance here is that rally should be faded. And so we will look for another opportunity to sell Eurodollar. From a fundamental point of view, the current account, the balance of payments has generally been a strong point for the euro in the past several years, not the case this year. There's going to be a greater likelihood probably that you see the current account deficit become much more sustained over the next couple of quarters, in part related to the high cost of energy imports and also much slower growth, much steeper, a greater slowdown in growth globally. So export sales are not going to be able to offset the import costs. And so ultimately, from a fundamental basis, that creates a drag on the currency. What was once revered as a positive anchor for the euro is now going to be a drag.
Not sure you could talk, Mazen, about the yuan, but looking at where it is and how it's weakened to these near 2-year lows against the greenback, and then we have, on the other hand, record trade surpluses we were discussing earlier that don't really fit together. So what is being priced into the yuan?
Yeah, so we think ultimately it will continue to weaken. But the path to get there is not going to be linear. And so I think we've seen in the last couple of trading sessions where fixings have been a little bit more on the stronger side of things. That's a bit of an indication that they do want to halt some of the weakness or arrest some of the weakness that we're seeing in the currency. But again, fundamentally, we're entering an era which is going to be extremely driven by or a heightened focus on the current accounts. And so what was a lot of portfolio inflows into Chinese markets, we're seeing basically an exodus of that. I think given the geopolitical situation currently and the slowdown globally, I think it's unlikely to see those portfolio flows reverse to be supportive of the currency. So ultimately, dollar China continues to be, dollar China higher continues to be, I think, a bias for us over the next several months.
I was also just going to, ahead of Jackson Hole, how do you position? Because, if you take a look at the yield curve for treasuries, at least, that yield curve inversion for 2s and 10s, we reached nearly about half a point of 50 basis points. Have we seen the worst of this inversion, Mazen, or do you think there's actually some scope to deepen further?
I don't think we've seen the worst. I think what we need to be looking at is a significant risk, if not the base case of a 1980s curve inversion, where you see anywhere between 80 to 100 basis points at least of inversion. And there's really two ways to get there. I think ultimately, if you have a higher terminal rate, or if the market and the Fed think that terminal is around 375.4, the other way to get there is that you keep Fed policy elevated well into a slowdown. And so this is now really looking at the Fed funds curve, basically pricing in some case for easing later next year. I think maybe going into the Jackson Hole symposium, the risk here is whether or not Powell pushes back on what markets have priced in, which is basically immediate cuts after it reaches terminal. I think markets have done quite a bit of work in trying to price in a bit of a hawkish Powell, but I suspect that Powell, looking at financial conditions, not tighter, certainly not something that I think the Fed is looking at or welcoming with open arms at the moment. I think the risk here is that they really lean into the market's pricing and cuts right after they reach terminal next year.
Right, and it's guesswork, as you pointed out earlier. So your estimate of the terminal rate at about 350, 375 is based on what then, Mazen?
Yeah, so that's based off of having a moderation in inflation coming down into next year. We're seeing this across central banks, and we're seeing this in the analyst community here, which is basically that you have inflation moderating in the next several months to 2023. But at the same time, as each month passes by, you see a positive revision to inflation projections. Look at the Bank of England, for instance, projecting basically double-digit inflation by Q1 of next year. And so you have the inflation side of things. And at the same time, I think there's a structural shift taking place, which is really occurring in the supply chains. And you're seeing a change in attitudes by a lot of places, whether Germany, whether it be Japan, on the kinds of energy that they're willing to now accept for their economies. That kind of pivot is not going to come cheaply. So I think we may be dealing in an era that has structurally higher inflation for quite some time, especially as supply chain shifts, whether it be on energy or more onshoring taking place. That creates a higher terminal rate in the next several months.